Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I am Billy, and as always, I am joined by my co-host,
Andrew. Back again, Bills. You added an extra as always there, so we've mixed it up a little bit in the intro.
Just trying to make it sound a little bit different because every week I think we have a chuckle about how the intro sounds the same each and every time. So
I've been wondering why hosts on shows always have the same introduction when they go on the show. I think it's just because there's just not enough creativity to mix it up every episode.
I don't know, either that or maybe it's just the muscle memory that comes with it, and the start's always the same. The end is very, very similar, and all the stuff in between is kind of different depending on what we're talking about. So I don't know, we've got to have some consistency, I guess.
Anyway, off on the tangent, I digress. Billy, what are we talking about today? What's the context of this episode?
So talking about something that we've come across a little bit recently, and probably just because we're dealing with a particular type of client, but self-managed superfunds. We'll use the acronym just because it's easier. Self-Managed Superfunds, or self-managed, or SMSF, I should say, is the acronym, meaning self-managed superfund, or we'll use self-managed, but we'll use all of that stuff interchangeably. But what we are meaning with all of that is a self-managed superfund, and we'll go into the details around, I think I've said self-managed superfund about 100 times. We'll go into detail as to what a self-managed superfund is, who they're, I guess, relevant for, what type of investor should be considering a self-managed superfund, and some of the intricacies associated with the pros and cons with going into an SMSF. So
yeah, absolutely. So a bit of a deeper dive into, one particular type of product and one particular type of asset class, in SMSFs. So really, what is an SMSF? I guess it's exactly as it sounds. It's a private super fund that you manage yourself. So a self-managed, hence you're managing everything on your own. And that's really sort of contrasted to, your standard wholesale, retail, industry superannuation funds, in that you're basically, liable and taking on the burden of managing the entire superannuation solution and all that comes and is entailed within that.
Yeah. So just to give it a little bit more context, superannuation in its basic form is just really a tax environment, and it's got preservation rules, and there's some concessionally taxed money that you can put in. That doesn't change whether it's normal superannuation fund, in the sense that the majority of people know it, a retail superannuation fund or an industry fund. A self-managed is absolutely no different to that. All of the rules stay the same. There is some little intricacies which we'll get into detail, but on the surface, everything stays the same. It's still a superannuation fund. It's just that the word self-managed, you are now responsible for managing that fund. And with that, you're taking on a lot of responsibility, and it does become quite onerous. You need to be careful with what you're doing, because if you get it wrong, the consequences can be expensive. And it's, depending on the level of assets that you are managing, it can be a bit of an exercise as well too. Andrew, talk about the control, some of the things that we can do in there with self-managed versus, I guess, a normal fund that we're used to.
Yeah, well, I guess, one of the biggest things or one of the biggest allures for people in going into the self-managed superfund environment is the amount of control that you have. When it's in a self-managed superfund, you can control exactly where it's invested, exactly what you're doing with your money that's for retirement, and you can, allocate that however you see fit. You don't need to invest in a certain investment option because that superannuation provider, allows you to invest in that option. You don't need to invest in particular shares because that's what's offered through that particular superannuation fund. You can basically do almost whatever you want with it, so long as it's for an investment purpose, so long as it's there and preserved for your retirement savings. So really sort of a significant driver for many people in going to a self-managed superfund is having that control over their investments and their retirement savings.
Yeah, which is, just to play the devil's advocate here, it's a little bit of a fallacy as well, because you still need an investment strategy that sits within there, and that has to be documented, and you need to stick to it. And the broad brush statement is that it needs to be saving and growing for your retirement benefit at some point in the future. But with most of the superannuation products that are available today, you've actually got that control It's just that you may not know that you've got that control. So one of the things that we talk to people and counsel them about when they're considering a self-managed super fund is, I guess we go back to basics and say, why? Because you're taking on additional risk. And we'll talk about the cost and some of the requirements each year and things like that. But you're taking on risk and complexity for, in most cases, in my professional opinion, not a huge amount of benefit. There are some people, and that'll become fairly evident in a sec in terms of who this is really beneficial for. But that investment choice that you've got should be available in most superannuation funds that are available today.
Yeah. And that's why sort of a lot of the times, rather than it being, having that control, it's just the illusion of control. I guess in a self-managed super fund, you've got a bank account, money goes into it, and then you feel like you're controlling exactly where it goes. Whereas provided that you're with a superannuation that, or a fund that has the ability to do so, most people in the self-managed super fund environment, a lot of the times, you're investing in shares, you're investing in term deposits and cash. And so ultimately you've got the ability to do exactly that and even purchase, direct shares if you wanted to in the retail and even sometimes industry super fund environment. So having that control, it really means that you have to look deeper and say, is this just an illusion of control, or is this actually control over where my funds are invested, and is it worth the extra burden that I'm taking on?
Yeah. So responsible for investment strategy?
Correct. And it has to be a documented investment strategy. Your auditor is also looking at each and every single year as well.
So the accounting of the actual fund itself, the record keeping, that then correlates or corresponds to doing a tax return for the fund each year and getting the fund audited to make sure it's compliant. So all of that responsibility that ordinarily is handed over to a superannuation trustee, and you're paying, I don't know, maybe $400, $500, $600 a year for it, you're now taking on that responsibility as a self-managed super fund trustee.
Yep. And most of the time, unless you're competent to do so, you're also paying a professional separately to do that.
Well, that's the other thing, because most people aren't doing that. So they are paying, I'd say, an accountant to be able to do the tax return, plus they're paying an auditor. So as you can see, all of these things start to stack up. We'll get into setup costs and running costs in a minute, but just the requirement around those two things are fairly onerous, and you need to know what you're doing, especially around, the money's in superannuation, you can't take it out. You need to be careful about how much money you can put in, because there's restrictions around that as well too. But if you put a foot wrong, it can get very, very expensive with penalties from the ATO. You have a self-managed superfund bank account. You don't have the same restrictions on that bank account like you do with your superannuation fund at the moment. So if you accidentally transact out of that from the wrong account, that creates a whole range of issues within itself. So yeah, tread with caution, I guess is what I'm saying.
Yeah, absolutely. And I guess most people don't realize, because you don't physically see it happen or you don't lodge it yourself, but a superannuation fund each and every year, it will automatically do a tax return for you. So it does a tax return, and it, looks at your contributions, the contribution tax, the earnings tax, and everything that's sort of all put together in developing the tax that your superannuation fund will pay. All of a sudden, you've got a self-managed super fund and you're now responsible for that. I guess the other difference as well is that it all falls on you. So like when you're doing your personal tax return, yes, you may receive advice from your accountant. Your accountant may, help you along the way. However, if there is an issue, if there is a mistake, the burden is on you, and you're responsible for, what happens with that tax return. And if something is wrong, it's ultimately, up to you when that tax return is lodged, unlike a regular superannuation fund, whereby there's another party that's physically doing that tax return on your behalf. And so if there are any issues, that other party, provided that, it's their mistake or their error, is obviously liable for that.
Yeah. Look, something as simple as if you're making a concessional contribution to your superannuation fund and it is being taxed at 15%, like it is, I guess the normal superannuation fund, so the non-SMSF, they're withholding that tax on your behalf and they're paying that money to the ATO. With a self-managed superfund, that becomes part of what you're doing, and you have to remit that to them when you do your tax return as well too. So that just gives you, a bit more of an understanding of, it's not saving you any, particular taxes or anything like that. It creates a larger burden for you from that perspective.
Yeah, and it makes it more difficult. You consider, and a lot of the times I've had clients that have been referred to me where there've been issues that exactly your scenario, they've made a contribution towards superannuation. That contribution towards superannuation has been utilized to, purchase a property or do something within that self-managed superfund. And all of a sudden, they've been hit up with a tax bill at the end of the day. And that money has already been invested in a property. So you don't have the ability to, sell a part of it or liquidate some of the assets in order to pay for it. And it can cause significant complexity in your situation. And so it's very much a situation whereby, making sure that you're receiving advice from the beginning and making sure that you're planning for all of these things is imperative when you're embarking on a structure like this.
Really good conduit, Andrew, into the setup costs. Because, I guess it was a lot easier in the past to be able to set up a superannuation fund. The ATO are a lot more stringent now about letting people do it, and they're looking into it a hell of a lot more. Not that long ago, rewind a handful of years and you can go online and set one up for $1,000. That's not the case anymore. The ATO are scrutinising that a hell of a lot more, but setup costs, you'd be talking to an accountant most of the time. You'd be talking to a financial planner in order to get an investment strategy associated with it. You might be getting some investment advice. You might be talking to the accountant about the taxation requirements. It is expensive to set these things up, and that's even before you consider where you're going to invest the money. So if you invest it in underlying assets, you may be paying management fees to an investment manager or what have you. So generally speaking, if you're going to do something like this, we recommend to do it with a larger balance because the setup costs and the running costs as well too are so expensive that as a percentage of costs versus your balance, it can get quite high. So you don't want to be doing this thing with, and we'll park it for a sec in terms of who it's applicable for, because we'll get to that in a minute, but you don't want to be setting one of these things up with a $50,000 balance if it's going to cost you, $5,000 or $6,000 to set it up.
Yeah, exactly right. And especially, if you're going to go through that cost and if you're going to go through that exercise, you want to make sure that it's for a specific purpose that you can't otherwise do without incurring that cost. So, and this is a completely outdated statistic, so don't hold me to it, but remember that the ATO had released a report at some point, I think it was last year or the year before, and it was something like 61% of self-managed superfunds were invested in cash. Now, cash for us is a term that we use to describe it's not physical cash, don't store it under your house. You're talking about term deposits and savings accounts. Now, when you consider that, in a regular superannuation environment, you can have the money invested in that same asset class without incurring, the costs and burden associated with a self-managed superfund. It seems absolutely crazy. And yet there's such a large percentage of self-managed superfunds out there that are just invested in an asset class that otherwise, you didn't need to go down that route if that is what you wanted to do.
Yeah, that's a really interesting one, Andrew. We might just pivot into that for a sec, but I suspect what has happened is right at the start of the podcast, you were talking about control, right? And having more ownership. And I guess as a consequence of that, you're probably looking at your superannuation fund, if it's in a self-managed fund, more so. This is a gross generalization, but more so than you would if it wasn't, because you're the one managing it. All of a sudden, you see investment markets start to get volatile. So you freak out and you move everything to cash. And then you're doing probably the opposite of what you should be doing at that particular point in the market cycle. It can work against you, as opposed to if it was just in a different fund and somebody was managing it on your behalf, whether that was the superannuation trustees or you had a financial advisor looking after it, you probably wouldn't make those decisions that easily. And you may even have, if you are under advice with an advisor, you may actually have somebody talking you through it, making sure that you're making an informed decision as opposed to an emotional one. So that statistic, I think, was driven a lot by people making the wrong decisions, and not only making the wrong decisions, but if they did move to cash, and we saw this a lot during March and April of 2020 when COVID first had the impact on investment markets, people didn't invest that cash again quickly enough into the markets to recover from the rebound. So it can also work against you from that perspective as well too. And I reckon that's what we've seen with what you're describing.
Yeah, absolutely. So I guess there's also, and sort of one of the other larger things to consider, and there's hundreds of considerations and, a million things that you need to sort of put together when you're formulating whether this is the right thing to do or not. But one of the other larger considerations is a self-managed super fund will have multiple members. So, or most of the time, there'll be more than one member in a self-managed superannuation fund. So when you're dealing with an SMSF or when you have an SMSF, the balance is still going to be associated with that member, and the preservation rules, the contribution rules, all of that stuff still continues. So you don't bypass any of the legislation that is already, in the superannuation environment. And so making sure that, okay, if I enter into an SMSF with Billy and Billy is 60 years old and I'm only 35 years old, well, all of a sudden, there's one member that's drawing down on the superannuation while the other member is accumulating balances within superannuation, and you still need to make sure that you're staying within the drawdown limits as well as the contribution limits in the SMSF. And it really can add a significant layer of complexity. And in particular, one of the sort of more difficult aspects of it is when there's assets like property in an SMSF, and one member needs to, pay out because they've decided to take a lump sum withdrawal from their superannuation fund, and the other member is still in the accumulation phase and can't actually sell out of their assets. You really need to make sure that if you're embarking on something like this, that all of the members of the SMSF are aligned in their investment philosophy, in their strategy, and what they're going to be doing moving forward.
Yeah, which comes back to, I guess, a couple of things in terms of the record keeping requirements. So even though you may look at the assets and it'd be one asset or one balance, I should say, internally with the ledgers that are in there, each member has a separate account balance and there's different activity happening on that based on all of those things. So as the complexity of the self-managed superannuation fund grows with more members at different ages, especially when you're talking with people, in drawdown phase and things like that, you've got liquidity considerations as well. It becomes a much, much larger administrative burden to be able to manage this thing and make sure that you're on the right side of it from a compliance perspective, because there are a lot of moving parts. And as you start to add more complexity and more members, the cost to manage these things and to stay on top of them gets, more and more expensive and more cumbersome. In saying that, I think we've been talking enough about the negatives associated with self-managed. Let's talk about some of the positives, Andrew. Why do people do it, considering all of these things that we've spoken about? And not that we want to detract anybody, we just want to try and inform so people can go into these things with their eyes wide open. But why do people do it? What's some of the reasons why, and some of the assets in particular, that you can access through a self-managed super fund? Tell us about that.
Yeah, so look, obviously we've spoken a little bit about control and sometimes there's an illusion of it, but in many times, if you're embarking on this, if you're doing it in the right manner, you do have a level of control that you otherwise wouldn't have the ability to do so. Specifically, and sort of one of the main driving forces around an SMSF is the purchase of property. So you can purchase property in an SMSF, whether that's residential property, whether that's commercial property, whether that's, a premise that your business operates out of. You can purchase property in an SMSF, and that's, I dare say, from my perspective, generally the driving factor behind the vast majority of people that embark on setting up an SMSF is having the ability to purchase property.
Yeah. And you go and couple that as well too with, generally speaking, when people purchase property, they leverage against it. So you're using the money, I guess, inside super to put as a contribution towards a deposit and then borrowing the rest. So it also gives you the ability that when you are buying a property, it gives you the ability to borrow against that asset to fund it as well.
Correct. And look, a superannuation fund, it's actually illegal to borrow funds in the superannuation environment. And so in an SMSF, when you're purchasing a property and when you're, embarking on borrowings, you create what's called a bear trust, which allows you to facilitate borrowing in the SMSF environment, which otherwise is just not possible. You can't do that. You can't do anything like that in the standard retail or industry environment. Whereas in the SMSF, you've got the ability to borrow. Now, one of the sort of things that I will sort of put on that is, yes, you've got the ability to borrow. Generally speaking, borrowing costs are a little bit higher. In addition to that, you've also got some requirements around making sure that you're receiving legal advice and whatnot. And so the cost to borrow are more. However, if that fits within your strategy and if purchasing property in the SMSF or in the superannuation environment meets the broader strategy of what you're trying to achieve, that's a lot of the driving force behind people entering into the SMSF environment.
Yeah, and just on that note too, Andrew, the LVR requirements with SMSF borrowing seem to be lower as well too. So banks and lenders in particular aren't offering the same amount of borrowings when you look at it from an LVR perspective. As we know, with a property, you can borrow, well, even north of 90%. With a residential property. With Self-Managed Superfund, we're probably capped out at about 70%.
Yeah. There's also some restrictions around, what you do with those borrowed funds. So you can't borrow funds in order to develop property or change the underlying use of that property. So there are some pretty strict requirements depending on, what you're trying to achieve and what you're trying to do in that environment. So making sure that you're, staying within those parameters, making sure that you're staying within the lines is really important, because it's really, we've seen it many times, and it's really easy to accidentally step outside, not with any malice, but just because a lot of the times there's some fairly stringent requirements when you're embarking on something like that in an SMSF.
Yeah, well said, well summarised, Andrew. And also just on that note about property, and I think this is a bit of a misconception as well too, is if you purchase property within a self-managed super fund, and we might use, there is one exception to this, which I'll get to in a minute, but we might use the beach house or the beach shack down near the water, buy that in your SMSF, rent it out, get rental income, fantastic. That goes towards your retirement savings. And we might just slip down on the weekend when no one's using it and use it for our own personal pleasure. That's against the superannuation rules, and you can't do that. Yep. So any asset inside superannuation is designed to grow and provide a future retirement income for you. You cannot derive any personal gain or pleasure off that particular asset.
Even if you pay yourself as well. So I've had the question of, what if I just pay my superannuation rent like any other person would? Yep. It's a related party transaction, and it is very strictly not allowed.
Still can't do it. Absolutely can't do it. So that's a bit of a misconception around that. And I guess probably back in the earlier days when property inside self-managed super funds were not as heavily scrutinised as what they are now, that was probably a common practice, if I'm fair to say. And I reckon people were doing that, but that's completely off limits now. And if you do get caught, the ramifications are quite significant. So you definitely don't want to be doing that. But there is one exception to that rule, and it all needs to be above board. It all needs to be documented. It needs to be done at a commercial rate of rent. But if you're a business owner, you can actually get your business to occupy as a tenant the building that you have purchased inside your self-managed super fund. So essentially, I'll just try and summarize that. You own the building in your SMSF, and your business is the tenant of that building or that property.
And then your business pays you rent, or pays your superannuation fund rent.
Yep.
And as long as it's on, commercial terms and all of that stuff, that's perfectly allowed.
Yeah, exactly right. So that's the exception that we've got to be able to utilize the asset that you own inside your self-managed super fund. But everything else that sits outside of that, you can't do it.
So business real property, that's the only exception to that rule. Which I guess is, when you talk about, personal use assets and making sure that it's strictly for investment purposes, there is a small part of the population that also uses an SMSF to buy other assets. I'll say alternatives, you can purchase collectibles, cars, artwork, things like that in an SMSF. So you can actually have that, again, for an investment purpose. So for instance, artwork that's purchased by an SMSF needs to be stored at a separate property. It can't be stored in your family home. You can't, put it on your wall and enjoy it for personal use. I dare say that that's a very small part of the market in an SMSF environment. And I dare say we've seen very few people that have actually utilized some of those assets. There's also the ability to, and I guess is really strictly for an investment purpose, but you're talking about physical gold, commodities, things like that otherwise wouldn't be available in the standard retail or industry super environment, but you can invest in and you can purchase through an SMSF.
Yeah, actually, I've got a real life example of that, Andrew. To give you some context, a client of ours has a self-managed super fund and bought a diamond, so a pink Argyle diamond. And not that you can debate it, but not that you can really turn around and say, hey, I'm using it for consumption or pleasure. But as part of the requirements of the fund, when he's getting audited every year to make sure that the fund is compliant, we really need two things for that diamond. One, it has to be in a storage facility, and that has to be documented. So he can't keep it in the cupboard at home and then go and take it out and look at it because he's using it for personal consumption or personal pleasure. And the second thing is it has to be insured. So he's got this thing in there. It's locked away in some, storage locker facility, wherever it may be, insured. Every year he gets the invoice, uses all of that paperwork to meet his compliance obligations. down the track, the idea is that it appreciates in value, and I guess he sells it. And that's how he's generating a return off that particular asset. But to give you an idea about how easily it is to get caught out, you could think, okay, I bought something like a diamond or even some bullion, locked it away in the cupboard at home or the safe at home or somewhere like that. Absolutely not allowed to do it.
Yeah. So look, very stringent in terms of what you can and can't do, and making sure that, everything that you're doing is purely for an investment purpose, for the purpose of your retirement. So I think that pretty much covers it in terms of taking a bit of a deeper dive into SMSFs, what they are, what they're utilized for, some of the benefits, but also some of the things that, you really need to take into consideration when you're embarking on something like this. As always, details are in the show notes. Always very much a proponent of, financial advice, whether that's from an accountant, from a financial advisor, or a combination of both when embarking on something like this. So feel free to reach out to both of us in the show notes. And Billy, thank you for another great podcast. And thanks again to all the listeners for tuning in.
Andrew, good work. To our listeners, thank you once again, and we'll catch you on the next one. Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaritis and Andrew Nicolaou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.